Welcome to The Explainer. I'm your host, and today we're throwing on our expert investment analyst hats. We're doing a total deep dive into USA Today Co. That's the legacy media and news syndicate trading under the ticker symbol TDAY. Right now, it's sitting at about $8.68 a share. We're going to completely break down their Q1 2026 balance sheet, run it through the valuation frameworks of legendary investors, and really figure out exactly what's going on under the hood of this media giant.
Okay, let's dive into this. $18.8 million. That is the jaw-dropping amount of incremental revenue USA Today Co. just generated in a single quarter. And here's the absolute kicker. It was driven entirely by AI licensing agreements. Seriously.
This right here is the ultimate hook if you're watching the media space today. I mean, we are witnessing a century-old legacy print newspaper generating massive, incredibly high-margin digital growth just by opening up its archives. Their AI content syndication and licensing revenue, it's shot up by an astounding 125.6% year over year. It has officially surpassed their programmatic display ad revenue. Talk about a game changer.
Section 1. The Fundamentals. Pivoting the business model.
And this brilliantly illustrates exactly what that pivot looks like. In Q1 2026, their digital revenues hit $261.9 million. That makes up 47.8% of their overall revenue, compared to 52.2% for the legacy print and commercial side. They are tantalizingly close to that massive milestone of 50% digital revenue, a threshold management actually expects to cross later this year.
But to get there, management is making a very deliberate and honestly kind of risky trade-off. They're choosing value over volume. Look at this. Total digital-only subscriptions are actually down 24% year over year. They literally lost nearly 500,000 digital subscribers. But right at the exact same time, their average revenue per user, the ARPU, shot up 42.7% to a record $10.30. So they're intentionally sacrificing overall subscriber volume to aggressively bundle their products and extract way higher revenues from their most loyal users.
Section 2. The Financials. Q1 2026 balance sheet snapshot. Let's look at the actual numbers.
We're just going to quickly run through these vital metrics. Total top-line revenue is actually down 4% to $548.5 million. But hey, don't let that fool you. Just look at the profitability. Net income swung positively by over $27 million, jumping from a $7.3 million loss last year to a $19.9 million profit this quarter. And adjusted EBITDA, that surged nearly 45% to $73.1 million. And here is the absolute engine behind that newfound profitability. Their adjusted EBITDA margin. It expanded by a massive 450 basis points, climbing all the way from 8.8% in Q1 2025 to 13.3% this quarter. They're drastically cutting costs and running a much tighter, more efficient ship. Which brings us to a metric absolutely crucial for any analyst, the debt. This 2.3x represents their first lien net leverage. It's actually a 12% decrease year over year, so they are actively paying down their debt. Though, to be fair, they still carry a really heavy principal balance of $988.3 million.
Section 3. The Guru Lens. Applying Lynch, Buffett, and Graham. Let's see what the masters would think.
First up, we've got the Peter Lynch lens. For Lynch, categorizing the company is step 1, and USA Today Co. is basically a textbook turnaround play. This is a formerly battered legacy company that's suddenly recovering its earnings. Remember, swinging from a loss to a $19.9 million net income, and they're using that cash to pay down a heavy debt load. While institutional ownership remains low, which is a classic Lynch positive, by the way, we'd still want to keep a really close eye on their forward PEG ratio as those earnings stabilize. But overall, Lynch would be highly intrigued by this momentum.
Let's move to and see how this builds into Warren Buffett's framework, which, as we know, is famously centered around finding an economic moat. Listen to CEO Michael Reed here. He explicitly stated that their AI agreements with tech giants like Meta and Microsoft are already moving the needle.
So if we run the Buffett checklist, TDAY actually has a unique, almost impossible to replicate economic moat. They have over a century of exclusive, structured news data that these foundational AI models absolutely desperately need. Plus, management is clearly rational here. They're aggressively cutting costs and shrinking the share base. However, Buffett generally demands a high return on equity and manageable debt. When he looks at that heavy leverage and the owner earnings, which are sitting at just $6.4 million in free cash flow for the quarter, That cash generation is probably just a bit too thin for a classic Buffett value play.
So what about the father of value investing, Benjamin Graham? Let's walk through Graham's strict, defensive quantitative metrics using the exact numbers right off their Q1 balance sheet. Number 1, positive earnings? Yep, they posted 12 cents in EPS. Number 2, adequate size. Yes, a $0.66 billion market cap definitely clears this hurdle. Number 3, book value. If we take their $141.9 million in equity and divide it by their 146.7 million outstanding shares, we get a book value per share of exactly 96 cents.
Now, if we assume an annualized EPS of 48 cents and run Graham's intrinsic value formula, the fair price of this stock is around $3.22, meaning at the current trading price of roughly $8.68, Graham would strictly pass on this stock because it just lacks that margin of safety. Furthermore, if you build a base case discounted cash flow model right now, say assuming a standard 10% WACC and a conservative 2% terminal growth rate, you find a really similar warning sign. That nearly billion-dollar debt load heavily restricts the fair value calculation.
Section 4. Investment risks and red flags. The bear case. Now, what's really interesting about this slide is that despite the massive surge in net income we talked about earlier, free cash flow actually dropped. It fell from $10.2 million in Q1 2025 all the way down to $6.4 million this quarter. Why? Well, because they paid out over $16 million in interest on that massive debt, plus millions more in reorganization costs. Cash is tight, folks.
And we simply can't ignore their legacy anchor. Print revenues are continuing their terminal decline. And remember that digital trade-off from earlier? Yes, they're charging more per user, but losing nearly 500,000 digital-only subscribers is a major headwind. Despite all the AI hype, the traditional newspaper business is incredibly heavy, and it's still dragging down overall top-line revenue.
Section 5, the final verdict, synthesizing the stock pitch. Let's bring it all together.
So the crucial point is this ultimate battle happening on their balance sheet right now. The bull case sees a Peter Lynch turnaround with a highly lucrative, wide-moat AI business. But the bear case? They see falling top-line revenue. When we look at the valuations, Graham's formula at $3.22, our restrictive DCF model, and even EV/EBITA comparables, they all currently sit below the $8.68 trading price, and it's almost entirely due to that suffocating debt load.
Which leaves us with the ultimate question as analysts. Is USA Today Co. a classic value trap burdened by print era debt, or are we watching a highly successful digital metamorphosis unfold in real time? Is that $18.8 million in AI revenue the spark that's going to save this legacy media giant? Study the data, run your own numbers, and decide for yourself. Thanks for joining me on this explainer, and keep learning.